Welcome back to the deep dive. Today we're opening up a topic that sits right at the intersection of corporate finance, legal risk, and really fundamental trust in the marketplace. We're talking about the doctrine of capital maintenance.
Hmm.
Now, for those of you who work in compliance or accounting, you'll know this one inside and out. But for a lot of people, it's this kind of invisible safety net. So our mission today is to take a deep dive into the very strict English law rules around how companies handle their capital.
And specifically how they pay dividends.
Exactly. And this isn't just some arcane bit of regulation, it's a critical mechanism.
It really is. And, the reason this is so crucial is that it gets to a core conflict in any modern company.
The shareholders versus the creditors.
The tension between shareholder appetite and creditor protection, precisely. We're going to explore why the law takes such a strong and sometimes, what seems like an intrusive stance to make sure a company's foundational capital is basically untouchable.
Okay, let's unpack this then. Because if a business is doing well, it's flush with cash, and the owners, the shareholders, want a payout. Why does the law get involved? Why is this initial capital so sacred, and who, at the end of the day, is this doctrine actually protecting?
It's aimed squarely at the creditors.
Right.
Lenders, suppliers, bondholders, anyone who provides credit to the company. They do it based on the assumption that the company has a minimum level of underlying assets. So the core legal function of the doctrine of capital maintenance is the legally mandated preservation of that capital.
Preservation.
Yes. Think back to how a limited company even starts. When it's incorporated, that initial capital from founders and investors gets recorded. That sum, both historically and legally, acts as the primary security. It's the financial buffer.
It gives people confidence.
It gives people confidence. If you loan money to a business, you expect that foundational pool of equity to still be there if things go wrong.
So it's not just a number on a balance sheet then. It's almost like financial hostage held for the creditors. But why can't a simple contract cover this? Creditors are savvy, right? They write covenants, they demand security. Why did the law need a whole doctrine for this?
That's an excellent point, and it gets right to the policy rationale behind it. Contracts are essential, of course, but the doctrine exists because of limited liability. Remember, limited liability is a massive benefit that the law gives to shareholders. They're shielded from personal responsibility for the company's debts.
So there's a trade-off.
There has to be a trade-off. Because the shareholders are protected from personal risk, the law has to create a substitute protection for the people lending the money.
And that substitute is ring-fencing the capital.
Exactly. If shareholders could just liquidate that capital pool and walk away, well, the idea of lending to a limited liability company would be, frankly, financially suicidal for anyone.
So the doctrine is the cornerstone of that whole limited liability compromise. The law is basically saying, you, the shareholder, get protection from debt, but in return, we, the state, will strictly control what happens to the asset base your creditors are relying on.
Precisely. And this is so important because of asymmetric information. A creditor can't monitor the internal financial dealings of a company day to day.
Of course not.
They rely on the legal assurance that the corporate structure itself has a boundary. The doctrine sets a strict, non-negotiable floor on how much assets can be depleted through shareholder withdrawals. That makes the whole system trustworthy.
Okay, so that establishes the why. It's about protecting creditors because of limited liability. Now, this is where it gets really interesting for me. How does the law actually enforce this in the day-to-day running of a business?
Right.
If a profitable company needs cash, but the shareholders are demanding a return, what's the ironclad legal mechanism stopping that money from just leaving?
Well, the enforcement mechanism is very specific, and it all runs through the rules on distributions. The law is designed to prevent what's called an illegal return of capital to shareholders.
Okay.
So any transaction that basically gives the initial capital back to the owners is, unless you go through a whole court-approved process, strictly forbidden. The key point is that shareholders can't be allowed to withdraw funds if that withdrawal eats into the capital base that's sort of, earmarked for creditors.
Because if they could, the owners could just bail as soon as things got tough, leaving suppliers and lenders with nothing.
Leaving them with an empty shell. Exactly.
So the most common way for that to happen would be dividends.
It would. And that leads us straight to the strict English law rules on paying dividends.
Yeah.
They are the main day-to-day enforcement tool of capital maintenance. The law doesn't care if you have a massive bank balance today.
It cares about the structure of your accounts.
It cares about the structure of your accounts. If a board wants to pay a huge dividend, they must prove conclusively that every penny is coming from legally available funds, and they are absolutely not touching that capital pool.
And this is where the English rules are particularly strict, right? I've had some other places have more of a general solvency test.
That's right, yes. Unlike some jurisdictions that just say, can the company pay its debts after the distribution? Okay, English law demands a rigid accounting calculation. Which brings us to the core operational rule. Dividends must only be paid out of what are legally defined as distributable profits.
Distributable profits. Okay, that sounds technical. When most people hear profits, they're thinking about, this year's net profit after tax or just cash in the bank. What does that term actually mean in this legal context?
It is a very technical term. And conceptually, what it means is that distributable profits are the accumulated realized profits of the company, minus its accumulated realized losses.
Accumulated. So over the whole life of the company.
The entire history of the company, not just this year's great performance. And the word realized is critical.
What do you mean by that?
Unrealized gains, say, a speculative increase in the value of an office building the company owns, generally cannot be distributed, even if it makes the balance sheet look great. The law demands genuine, earned profits that have been secured. Cash in the door, essentially.
That's fascinating because it means a company could have a phenomenal year, clear, say, 20 million pounds in profit, and still be legally barred from paying a dividend.
Absolutely.
Can you walk us through how that might happen? A successful cash-rich company with zero distributable profits.
Of course. Let's imagine a company, we'll call it Megacorp Solutions. They went public 5 years ago. Yeah. Years 1 and 2 were a disaster. They racked up 50 million pounds in realized losses trying to get market share. Years 3 and 4, they broke even. Then in year 5, they finally hit the big time. They have 20 million in current realized profits, 40 million cash in the bank. The board is thrilled. They want to reward shareholders with a 10 million pound dividend.
Sounds reasonable. They're profitable now. They have the cash.
Legally, they cannot do it.
Why not?
Because despite the high cash balance and the current 20 million profit, their accumulated losses are still 50 million. They first have to use that current 20 million profit to offset the historical 50 million loss.
Which still leaves them 30 million in the hole, historically speaking.
Exactly. Their distributable profits are zero, or, well, less than zero. So they can't pay anything out.
So the company is solvent, it's liquid, it's profitable now, but the law blocks the dividend because that historical 50 million pound loss hasn't been fully replenished yet.
Precisely. If they paid that dividend, they would effectively be returning capital, not profits. They'd be dipping into the money that was supposed to be ring-fenced. Creditors trusted them on the basis that they would eventually recover that lost capital. A dividend gets in the way of that.
That forces directors to look way beyond the current quarter. It seems so rigid, though. I mean, what if the board knows for a fact that next year will be even better? Is there no commercial flexibility allowed?
The law is famously rigid here, and that's by design. It's specifically to remove that kind of director discretion and protect creditors, absolutely. The calculation is backward-looking and forensic. You either have the distributable profits on paper, according to defined accounting standards, or you don't.
No ifs or buts.
No. And if you connect this to the bigger picture, it forces a certain financial discipline. It stops directors from, say, chasing a short-term stock bump by issuing a dividend when the company's underlying financial history is actually weak. It prioritizes long-term solvency over immediate shareholder gratification.
So the law is almost acting as a check against optimistic accounting or pressure from the market to perform. It's a check on that kind of aggressive earnings management.
That's a perfect way to put it. And it's why this is such a central concept in compliance and governance. Like in the ACCA context, a dividend paid illegally when there were no distributable profits is what we call ultra vires.
Yeah.
It's void, and the consequences are severe.
Which I suppose brings us to the final summation of this deep dive. The doctrine of capital maintenance really just boils down to a fundamental promise to creditors.
A non-negotiable one.
And that promise is upheld by this very strict rule that dividends must only flow from defined, verifiable, distributable profits, money that is surplus to everything else.
Exactly. It's simple in theory, capital must be preserved. But in practice, achieving compliance requires incredibly precise and diligent accounting.
And it leaves us with an interesting thought for the road. If preserving capital is so critical to protecting creditors and maintaining trust in the market, what happens legally when a company gets it wrong? when they pay out money unlawfully and dip into that protected capital.
Well, that's the pivotal next step, isn't it? When an unlawful distribution is made, the directors who authorized it can face personal liability to restore the funds to the company.
Personally liable.
Personally, and what's more, shareholders who received that illegal dividend, if they knew or had reasonable grounds to believe it was unlawful, they might have to pay it back too.
So it's not just a slap on the wrist for the company, it could be a personal financial crisis for the management team. Something to mull over the next time you see a big corporate headline about balance sheets and shareholder payouts. Until next time, keep digging into those details.